Good afternoon, everyone. Welcome to another mortgage-backed securities video. So there was recently another FOMC meeting that the Federal Reserve held. This was December 14th and 15th. Essentially, they hiked their policy rate by another 50 basis points. And guys, what shocked me is that interest rates are at center stage. Nobody's talking about the balance sheet runoff. Nobody's talking about mortgage-backed securities. Here on the screen, you see the mortgage-backed security Federal Reserve portfolio for the year 2022. And as you can see, towards the end of the year, we're finally starting to see that the mortgage-backed securities are running off of the balance sheet, and the Federal Reserve is no longer buying them. So what we have to ask ourselves is, who is going to buy them from the banks now? Because the banks are very used to the government buying them from them. So guys, I want to show you kind of this, I think, what's going to end up being kind of a debt spiral. So if you look at the yellow box on the bottom right, banks aren't able to find buyers for mortgage-backed securities. That's kind of what we're hearing. So government is no longer buying them. So who's going to want to buy mortgage-backed securities at a time when interest rates are going up and people are predicting that house prices might eventually start to go down? So what are banks going to have to start to do? They don't want to hold mortgages and take on the risk of the mortgages. They want to put them together into these mortgage-backed securities and sell them off to investors. So the investors are going to be investment firms, pension funds, essentially private companies. So they're going to have to start raising the coupon rates on those mortgage-backed securities, because those are kind of riskier assets and people are going to want higher interest rates. So if they increase interest rates, they're also going to have to increase interest rates on mortgages, because you have to kind of match that. If you increase the coupon rate on the mortgage-backed securities, you have to increase the rate on the actual mortgages that are part of that package. So that's going to make mortgages more difficult to sell, because consumers are not going to be able to afford mortgages that have a really high interest rate. So then the banks are going to have to go back and lower interest rates on mortgages, and then they can't find buyers for mortgage-backed securities because of that reason. And then they're going to have to raise the coupon rate for the mortgage-backed security again. So guys, I think what this is going to lead to is that banks not banks, is that the 30-year interest rate on mortgages and the 10-year treasury rate, I think they're going to start coming close together. So currently the 10-year is at about 3.5% interest rate, and mortgages, the 30-year is currently at like an average of 7%. So either the 10-year treasury is going to start to go up a lot, or mortgages are going to somehow go down. I think personally that the 10-year treasury is going to start going up because this process during which there's going to be less and less liquidity, bonds are going to have to demand more money pouring into them. Otherwise, investors are not going to want to invest. So I hope this makes sense for everyone. If you have ideas about what's going to happen, or any questions about the mortgage-backed securities market, do let me know in the comments below.